Good morning, good afternoon. Well, hello to everyone. Welcome to this NATIXIS conference today. The big question that we want to discuss with you today with Patrick Artus. I have the great pleasure to have Patrick Artus with me to discuss inflation. There are probably as many scenarios as economists. Lots of things can happen on inflation. Maybe one thing for sure, that it's very difficult now to discuss inflation, calling inflation as temporary. We have seen that this is a call long gone now. So what we propose to do with Patrick is to try to discuss the main thematic around inflation. What are the dynamics? What are the underlying factors, in your view, the most important going forward? So this kind of discussion that we want to have with you, so as usual, as much as interactive as possible. So please use the chat. I will be having your question along the way and try to pick up as many questions as possible. So please do not hesitate to reach out with questions for Patrick and myself. So we decided with Patrick to follow kind of a plan on that. So Patrick, what do you think are the different things we have to discuss today?
Okay, I think we have first, good afternoon, everyone. I think we have to discuss a number of issues. Probably first, to give a number of facts. What do we see actually in the economies? I think we'll focus mostly on the US and on Europe, but if you get afterwards questions on different regions, don't hesitate. We have at some stage, we have to allude to what's going on in China. And so I think we have to start with just a number of facts and to tell where we stand. Then, of course, we have to look at the different possible scenarios. Unfortunately, there are as many as 5 possible scenarios, but some of them will be immediately excluded. But then we have to focus on the more likely scenarios. The big issue basically here is to know whether what we see is a temporary increase in inflation that will end up with inflation almost back to normal, almost by itself on a spontaneous basis, due to the normal mechanism of the economy, or whether what we have is a more permanent regime change where the economies move to a more inflationary regime, even in the medium run, which of course would force very important changes in policies. Then, of course, to discuss that, we have to discuss labor markets, we have to discuss commodity markets, and we have to discuss central banks. This is what we do next. As we will see, there is a very big asymmetry between the US and the euro area. So really the discussions are very different in 2 cases. And finally, having done that, we can certainly focus on what is for us the most likely scenario, and then tell what it means for the capital markets, for your asset allocation as investors, for your investments as corporates, and so on and so forth. So just take 1 minute for the facts, and then Jean-François will continue with the scenarios. So I don't know what it does. If I could turn the slides, it would be perfect. I just want to, doesn't work. I just wanted to start, this is it, but I wanted just to start with just a very simple comparison between the US and Europe. So what you see here, first for the US, is the blue line is the inflation as CPI, so 8.6%. And the dark line is a deflator of GDP, which means the prices set by corporates. And what you see in the US is what I call a mature inflation. Inflation has gone through the different mechanisms, so price formation, wage formation, and most of inflation now is domestic. You see that domestic inflation is very close to total inflation. If you look at the same for Europe, this is what you've got here. You see a very big difference. The majority of inflation is still exogenous in Europe. It's due to import prices, to commodity prices, and domestic inflation is less than the half of total inflation. Now, this is very important because it means that, you can have 2 interpretations of that. One is that a lot of inflation in Europe is still in the pipe, which means that when companies start refixing their prices, when wage negotiations just settle new wage arrangement, then we have much more domestic inflation compared to total inflation. And another interpretation, which you are very often listen to, is that the ECB doesn't have to react to that time of inflation because it's based mostly on commodity prices, on import prices. And this is a very big mistake. I mean, if you've got inflation due to import prices, to commodity prices, it's a supply shock. But then the ECB can respond to that by depressing demand. And you've got inflation due to a very positive demand shock, like higher wages, like more credit. Then the ECB reacts by depressing demand by exactly the same. So the argument that because it's oil and other commodities, the ECB doesn't have to react is completely wrong. It's exactly the same if it's a supply shock, a negative supply shock, or a positive demand shock. The reaction of the ECB is exactly the same as the two cases. So the second argument is not valid. What's very interesting is, this is what we want to look at now with Jean-François, is whether the European model of inflation, again, which is still mostly exogenous inflation coming from commodity prices, will move or not closer to the US model of inflation, where most inflation is domestic. And I just finished by... I don't know what's going on with the... That's better. Okay. I just want to finish with one element which you get here, which is to show that the risk of inflation is larger in Europe than in the US. This is import prices, import price growth. Import prices are the initial source of inflation, is where the initial shock is coming from. You see that import prices have gone up by 12% in June, year over year in Europe, and then in the US, and by 28% in Europe. So the size of the inflationary shock is much, much bigger in Europe. A big chunk of that is due to the euro, of course, which means that if the European process of inflation was really converging to the American process of inflation, then inflation in Europe would, at the end of the day, be much higher than in the US. So the risk of inflation is much larger in reality in Europe than in the US.
And probably this is mostly due to energy crisis in Europe, which is more demanding for European economies. Clearly, US is a net exporter of gas and oil, which is not the case of Europe. Europe was importing 40% of its gas from Russia. So obviously, the big increase of energy prices is denting more Eurozone than the US. Question is how far or how long does it last? In a way, this price increases in Europe compared to what's the case last year. One way to look at that is to say that, well, it's very difficult to imagine, think of that, the oil prices in Europe has been up by 500% over the last 18 months. Gas prices might multiply by 6. It's difficult to imagine that continuing at the same path, at least. The big question, is it going to stabilize or not? Or is it going to have another round? I will discuss that with energy just after with Patrick. Question is around that. Is it possible to imagine that price keep being at this kind of level, or are they going to stabilize or going downwards, which are going to have a strong basis effect? That's a big question. And back to what Patrick was mentioning, clearly it's a bit of a race between the ECB and wage negotiation in a way. How long does it take for Europe to become more US style, where wage increases are starting to catch up with price increases? That's a big question for the ECB, and we have seen that this is not the case today. When we look at wages in Europe, we do not see that. If you look at Netherlands, we are 2.8%. If you look at France, we are probably close to be below the natural level of unemployment. We can discuss that later as well with Patrick. And still, you see wages in 300 branches below 3% of increases. So far, it's a big, very important statement. So far, no wage increases that much. But when you look at Spain, for instance, and we see that half of wage negotiation see some kind of indexation clause into it. So we're probably going to be a bit more US style going forward. So this is a race between Europe wage negotiation and the ECB, and probably it explains why the ECB is accelerating, even though for lots of people it's quite slow. In fact, the ECB is going to be raising rates probably by 200 BPs this year, so trying to stop the idea of disanchoring of inflation expectation being quite early in the process, because there are no big wage increases. The big impact for inflation so far is energy. And once again, between 50 to 60% of inflation is explained by energy. So if you want to look at inflation, first thing first, you need to look at energy. Talking about energy, maybe just to finish on that, we think it's going to consolidate a little bit going forward, but we will discuss that just in a moment.
Just to start the debate on I think on a more on a clear basis, we have to start with what I mentioned before, which is what are the possible scenarios. The first one, which is still the market scenario. If you look, for instance, at the expected inflation, which you will see here, that's inflation swaps. Look at expected inflation in Europe, or it's a chart just before in the US. You see that the markets are expecting high inflation this year, but inflation getting back to 2% as early as in 1 year time, and below 2% in 2 years time. So that's absolutely striking. So this scenario is a scenario where you've got not a lot of, especially in Europe, not a lot of monetary tightening. As Jean-François mentioned, even it's 200 BPs this year, I mean, when you've got 9% inflation, it's very far from very severe tightening. And inflation is back to normal very rapidly. And this is perhaps associated with a recession, but when you look at the data today, data is not really consistent with a recession in Europe, or if you see more weakness in the US. So the market scenario is this soft landing scenario where the ECB does little, where the economy remains reasonably not strong, but I mean is not becoming very weak, and still inflation gets back to the 2% target in a very, very rapid pace. Honestly, this scenario has a probability of being realized of about 0. It never happened in the past. And as Jean-François mentioned, you've got strong lessons from macroeconomics. One strong lesson is that if you want inflation to come down, then unemployment has to be above structural unemployment. As long as unemployment is the lowest in many, many years as we have today, inflation is not coming down, it's going up. So the first move that we need to have if we want lower inflation is a move where the economy weakens sufficiently that unemployment goes above structural. In Europe, it's about probably around 8.5%, or 8 to 8.5%. Today's unemployment is below 7% in Europe. So we need unemployment to come up by, let's say, 2 points before we can have the slightest hope of seeing lower inflation. So again, this soft landing scenario, it just never existed. It won't exist this time again. Second scenario, where a lot of our colleagues, especially of academic economists, think it has some probability to be realized, is a scenario where the ECB just decides not to try to meet the 2% target. So basically, the ECB changes the inflation targets, perhaps unofficially, and is pleased with inflation staying like at 3.5% for the next 2 or 3 years. So the ECB does little efforts to bring inflation down because it doesn't try to bring inflation down. Honestly, from an institutional point of view, I think that's very, very complicated to believe. There are many countries in Europe, I mean, apart from France or in Italy, probably, where, I mean, there's this real will to bring inflation back to a much lower level. So I think it's very complicated for the ECB to do that. And Christine Lagarde keeps telling that she wants to bring inflation back to 2%.
Officially, and the ECB has this target of inflation going back down to kind of surprisingly around 2%, just above at the end of the horizon of forecast by the ECB to 2.1%. So as long as it stays the case, the ECB will be hiking rates probably by 50 BPs in September. We'll be back into that. But clearly, the ECB in his account is expecting wage growth to be around 3% and inflation to be normalizing toward 2.1% in 2024, end of 2024. So quite, no big change in regime, as Patrick was mentioning. While we can think that we are going to see some catch-up effect, it's very difficult to, and we'll discuss that just after, but it's very difficult to imagine that the energy transition, the big switch out of Russia energy, the big switch out of fossil energy, the big deglobalization in a way, or at least regionalization, is not playing in favor of higher regime of inflation going forward. So it's very difficult to imagine to be back to normal. What the market expectations are showing is that it's just a blip, and we come back to old world. This is not something we believe in. It's going to be a higher regime of inflation going forward. It's a big question, and the kind of debate we have with Patrick: is it a self-fulfilling new rising inflation regime, or is it just a stabilization at a higher level? That's a big question mark for the ECB and for the central bank all over the world, probably.
Now, if you look at the rest of the scenarios, there are one scenario again which is interesting, but which is not the solution. It's a scenario which is possible where the economy slows down rapidly, but because of value chain constraints, because it's harder to import natural gas, chips, semiconductors, metals, whatever. So you got a lot of supply chain constraints. And companies find it very complicated to get the necessary supplies. So you got a number of plant closures, because of that. And this ends up, of course, in the economy weakening. The reason being, again, many shortages for different items and many commodities. Of course, this is probably partly happening. We see that today. But the outcome of that would be much higher inflation. If you got lower growth because of shortages, you don't end up with lower inflation, you end up with higher inflation. It would be the most horrible scenario for the ECB. It would be a pure stagflation. So don't forget that if you believe that the economy weakens and that the main cause for this weakening is supply chain problems, shortages for different commodities, you're not solving the problem of inflation. You're making it worse. It would be a recession with more inflation. So this is not absolutely. And then, of course, the problem for the ECB would be even more complicated. And Jean-François, I'll just take 10 seconds. So I think the two scenarios we have to focus more on are the two most likely ones. Number one is the one where, for other reasons, for reasons which are not shortages, the economy weakens. Because, for instance, real wages diminish, our problem with purchasing power, because companies invest less, whatever. So you got an endogenous weakening of the economy, and it is ending up with lower inflation, and the ECB doesn't have to contribute too much to that. Or number two is a scenario where the economy by its own doesn't weaken sufficiently, and then the ECB has to do a lot, has to tighten a lot to bring unemployment upwards and to weaken the economy and to kill inflation the way it did in the past in the 80s, 90s. So I think this is really the two scenarios we have to decide between. One where I got some form of endogenous weakening of the economy, which is not very much due to the ECB, so the tightening is limited, and one where the ECB has to trigger the weakening of the ECB, and then you need, of course, a much more significant tightening.
What we do see at the moment is some kind of normalization in terms of semiconductor prices, freight, container prices. We see some kind of normalization by more than 25% over the last few months. So it's normalizing. But one reason for that was probably because China was closed. Now that China is reopening, the big question is it not going to reaccelerate the demand side of this stuff, and we shall see where it goes in terms of inflation. Clearly, what we see at the moment is a kind of a normalization of prices. The only prices which are not normalizing is obviously gas in Europe and TTF, for a reason that we know. There is a war, there is some shortage, there is some problem of production, probably temporary, if we can say that again. But oil prices. But again, for the rest, we see some kind of a normalization. So far, what we see once again is no big wage increases all over Europe. I think of, like I said, Netherlands, 4% in the 1st of July. The minimum wage in Netherlands, 1.5 0.85% the 1st of July. In Germany, everybody is jumping around saying, well, IG Metall is going to ask for 8%. But as usual, it was the case before the COVID. And usually they get half of that, and it's for 18 months. So all in all, we're probably going to end up with 4% and 3.5% next year. So we are in this kind of 3-4% so far. Once again, I keep repeating that. We are around that. The steel industry is the same kind of thing. We are around 4%. ECB is betting on 3%. It's probably a bit low. But again, very much of that depends on what comes next. And my view is that we probably end up in September with some more wage negotiations, so probably north of 4%, 5%, maybe more than that, at the same time as the economy is going to decelerate quite massively with this shortage Patrick was mentioning, especially in Europe. If we have to put some numbers, we expect Germany to be at 1.8% GDP growth this year, but if we have a full embargo in gas coming from Gazprom and Putin, you can cut GDP growth for Germany one more point, one additional point. So we are 0.8% only. So this deceleration is coming fast. And in our account, it's coming fast as well in the US, despite the fact that we are saying, okay, they are less dependent on energy. They are still big importer of energy as well in the US. But the US economy shall be decelerating fast in our view. We expect the US economy to end up 2022 at minus 0.3%. So it's a mild recession in the US, but it's a recession still. You have seen that the first quarter has been revised downward, minus 1.6. Fed Atlanta is showing as well some recessionist indicators. So even in the US, we're probably going to see a deceleration. But then the Fed has done the job as well. Patrick was mentioning that. The policy mix between budget and monetary policy is both are counter-cyclical in a way. They are just trying to decelerate the economy at the same time, while in Europe it's still not the case. Again, this deceleration that we see in the US is going to happen probably even more in Europe. So question mark is how far the ECB can be good. How far the ECB can go before the economy decelerates and start to question the ability to go much further.
This is very interesting because there's a very big double asymmetry between the US and Europe. The first asymmetry is fiscal policy. Fiscal policy is extremely restrictive in the US. As a budget deficit will come down by more than 4 points of GDP this year compared to next year. This is very much due to the fact that Biden couldn't pass almost anything through Congress. So we have a very big tightening of fiscal policy, which is a number of cuts in public transfers, to SMEs, to households. And so most of the weakening of the US economy, in reality, is not coming from the Federal Reserve, it's coming from fiscal policy, which is very interesting for economists because something more and more economists argue that basically the fight against inflation should be done more by using fiscal policy and less by using monetary policy. This is exactly what we see in the US. So when the Federal Reserve, and I can show that before going to what I wanted to show you, when the Federal Reserve, so I think commodity prices, I will say a word, but when the Federal Reserve is expected to do this, which is to go to 4% by the end year and then to start stopping, basically, this is just a complement to what fiscal policy is doing. This is not the main cause of the weakening in the US. The main cause of the weakening is a cut in income due to fiscal policy. And that's very important to understand. In Europe, it's completely different. In Europe, fiscal policy is not restrictive. Governments are supporting the income of the people. You've got different ways in different countries, but in all countries, you got more and more public money spent on mending real incomes. And so fiscal policy is not at all restrictive. So in Europe, monetary policy is by its own. If there is a weakening of the economy in Europe, it cannot be fiscal policy. It can be two things. What Jean-François already mentioned, which is the number of rationing, a number of scarcities. So we've got scarcities, of course, you have to produce less, got to close. But scarcities would be more inflationary, I just mentioned that. So for instance, if there is a complete stop in the supply of Russian gas to Europe, then of course the economy would be weaker. but inflation would skyrocket, and that would absolutely not support the ECB. It would be absolutely horrible for the ECB, but the lower growth and more inflation again. And the second, of course, source of weakening, which is not in your fiscal policy. Fiscal policy is about neutral. It's monetary policy. So this is a main reason why I think, perhaps Jean-François disagrees, that the ECB will have to do much more than what is commonly expected today, which you see here. If the ECB goes to 2.5% next year, I mean, in a situation where fiscal policy is neutral, where inflation might become higher because of the number of scarcities, and where inflation would be around 9% by the end of this year, this is clearly not enough to bring inflation down and to raise unemployment and to bring inflation down. So I don't have a problem at all with the US scenario. I think we see clearly what's going on in the US as the economy is weaker. Most of that is coming from fiscal policy and lower public spending. But in Europe, I have a big problem with the market scenario, which is much lower inflation, with not much lower rates, and in an environment where maybe we'll have much higher commodity prices because of the war in Ukraine. If this happens, I mean, it doesn't just work. I mean, you cannot have 2% rates, inflation back to 2%, and higher commodity prices. So something is wrong in the market scenario for Europe, whereas the market scenario for the US makes sense, basically. So again, I just wanted to tell, and then I give the floor back to Jean-François, that the ECB is facing a very complicated task because it has to bring inflation down, and it has to bring inflation down, and it's facing two difficulties. Difficulty number one, of course, is that, as said before, fiscal policies are very supportive of domestic demand. In France, for instance, as you know, the French government spends 50 billion euros this year in supporting the real incomes and purchasing power. So at the time monetary policy would become restrictive, fiscal policy becomes expansionary, which is a very big conflict between these two policies, and this is making the job of the ECB much more complicated. And second is a big change in regime on the labor markets, and Jean-François already mentioned that. But if you look at what I had before, which is just here, I mean, sorry, it's just two charts before. It is just here. When you look at hiring difficulties and recruitment difficulties in Europe, the same in the US, they are at an incredible level. You've got, in France, 2.5% of the jobs are vacant, are not being filled. So this is also something which is making life for the ECB more complicated, because even if the economy slows down, companies will keep filling these jobs. So there will be a big inertia between GDP and employment, basically. So you see my point, is to tell, if you believe in weaker GDP growth because of gas supply, whatever, I mean, semiconductor supply, then it's not something that will help VCB because it will mean more inflation and not less inflation. And VCB is facing a very complicated task, A, because fiscal policy is becoming more and more expansionary, and B, because there will be an enormous inertia of job creation vis-à-vis GDP growth. So at the end of the day, my conclusion, and what Jean-François will tell his, my conclusion is that rates will move up well above what is commonly expected by the markets in Europe, not in the US again. US is fine. I mean, because again, in the US, the economy gets much weaker because of fiscal policy. That's a completely different scenario. But in Europe, we have this big problem that the ECB is fighting against fiscal policy and against the labor markets. So 2% certainly doesn't work to bring inflation down in that environment.
There we have a bit of a market in that respect. Now in the US, I totally agree with Patrick on the budgetary side, but on top of that, I will be adding two things. One, the monetary policy is doing its job massively as well. The tightening of financial condition in US is unprecedented since 2008. And when we had this kind of tightening of financial condition in the US, usually the Fed is cutting rates. So it's a massive tightening of financial condition. Again, think of the mortgage market. It's the loan demand is at the lowest since 22 years. We see that very, very much at play. And despite this low unemployment, we can clearly agree on the fact that we are at full employment in the US at 3.6. So we reach the lowest point since 1957. We are close to where we were with Donald Trump. So 3.6 full employment in the US. But despite that, what we do see as well is that the real income, the real wages in the US are massively negative, in fact. So you are losing purchasing power in the US. So the consumption and the confidence of households in the US is at record low for good reason, is that even in the US, despite its full unemployment, you are losing some purchasing power at an unseen magnitude. So it's minus 5.5 for the real disposable income. So this is massive, and consumption is 70% of US GDP. So you have all three factors in the US playing at the same time: budgetary, monetary, and private consumption as well. So this is clearly a very, very powerful argument for us to expect kind of a small recession in the US. When we go down to Europe, it's very difficult again to imagine a wage spiral in Europe when we see that we are not probably in the same kind of story. Once again, as so far, 1st of July, we do not see a double-digit figure inflation. And our point is that the ECB is too late in the process, and when we are going to in Q4, it's going to be super difficult for the ECB to accelerate. And think of BASF in Germany. They say if we cut gas further, we are going to put 40,000 people in partial unemployment. So the pressure on wages in this kind of context is going to be difficult. And like as Patrick mentioned just earlier, we are going to see a rising unemployment at some stage if the ECB keep tightening. So it's going to be a very, very difficult job for the ECB. Hence, our expectation for the ECB is, for me, it's very difficult for the ECB not to do 25 in July. Doing more than that after what Christine Lagarde kept repeating lately. I'm going to do 25. I'm pre-committed myself. Read my lips. Blah blah blah. It's very difficult for ECB without losing full credibility. Not doing 25 only, if I may. And then 50 BPs for me is a done deal as well in September, which is a big step for the ECB, like a bit the 75 for the Fed. But again, they have been pre-committed themselves. They are still debating between 25 and 50, but will be very surprised to see more than that in September. And after that, for us, it's going to be 25 going forward. Why is that so? Because once again, we see this deceleration of economy, rising unemployment pressures. So the wage spiral probably will be decelerating. So the peak of inflation, in our view, is during Q3, Q4 in Europe, and that's a debate that we have. And probably the peak of wage demand will be there, because in any case, 2023 is very difficult to imagine rising inflation compared to this year just for energy prices' sake. We expect energy prices at worst case scenario to be around this level, but again, the basis effect will be stepping in big time next year. So we expect inflation to decelerate a bit, like the Fed is expecting. The Fed, the ECB. Not to say I'm in good company, because everybody was wrong before, but it's our scenario to see gas and oil prices to stabilize at a lower, not that much, but lower level compared to this year, around 95 for both, to give some numbers.
Let's summarize, because we go to the markets. Just I wanted to show that, which is also important in the discussion, which is household savings. In the US, there is a tremendous collapse in savings, which is not really de-saving, it's borrowing, it's credit. And of course, as rates move up, this will slow down. So this is going also in the direction of weakening the US economy. In Europe, there might be more to go. You see, savings are still much higher in Europe. They're still above normal. At the same time, rates move up as well. But we have more potential probably in Europe, to support consumption by this saving. Now, just to conclude on this section, and then we go to markets. Again, as you see, we don't fully agree. And not in the US. In the US, there is absolutely no problem. I just tell you really what I think for Europe. I think you got really two scenarios. Scenario one is a scenario where the problem with commodities gets worse. So you get very scarce commodities. The Russians start exporting more natural gas to Europe. Then, of course, the economy weakens. Then, of course, as the economy weakens, job creation weakens as well. As job creation weakens, wages increase less. But you've got a new burst of inflation coming from commodity prices. And then you end up with more inflation. It will not be wage inflation. It will be commodity-based inflation. And scenario two is a scenario where things don't go that bad. Russians start again supplying more natural gas to Europe. Commodity prices come down slightly. and then the economy does not weaken, and then unemployment stays at very low levels, and then wages accelerate, and then you got more wage inflation. So you cannot escape inflation. In case one, it's commodity-based. In case two, it's wage inflation. But in both cases, you've got, of course, inflation will be lower than this year. But in both cases, my conviction is that inflation would remain above the ECB's target, even in 2024. Again, in case one, it will be with much higher commodity prices. In case two, it would be with an acceleration of wages. But I don't see a scenario where we've got no inflation at all.
And we totally agree on that inflation will be above ECB target, and we expect the core inflation to be 3% again next year, so well above the target in core inflation only. So we agree that we are not going to be back to a pre-COVID or pre-Ukraine war thing. Question interesting in that context for around the labor market, Patrick, because we see that the bulk of job creation is in service, if I may, in gig economy. So we are in a labor market. There are lots of discrepancies within the labor market. So there's an interesting question about the labor market distortion between with the rising temporary work on new economy. How does it fit in the picture in terms of wage dynamics?
Well, you mean Europe or the US? The picture is very different. In the US, labor supply has come down by 2.5%. So you've got 4 million Americans out of the labor market. You got that in the UK as well. So when you see hiring difficulties in the US, it's very obvious. I got less people trying to have a job. In Europe, it's much more complicated because the level of employment is above the pre-COVID level. We have, especially in France, but through Europe. So it's not a global reduction in labor supply, which is coming hiring difficulties. It's just a question here is because of a big growing mismatch at the sectoral level between labor supply and labor demand. Wage earners do not want to work in the industries which are hiring. And so this is creating a very massive problem with hiring, which is not due again to a shortage globally of labor supply, but which is due to a shortage at the sectoral level. Now we've got to be very careful because if you look at you can lose. I did a very detailed piece on that. If you look at the tech industry, for instance, it is reporting immense hiring difficulties, but the number of jobs has grown very fast as well. So it's very misleading.
This day they're laying off.
So you got many more people working in the tech industry in Europe, but still the level of hiring difficulties. Just the opposite, you got hotels and restaurants where you got also immense hiring difficulties, but the number of jobs has gone down. So they can really not hire. In the tech industry, they hire a lot, but it's still not enough. So it's complicated. But the base of the problem is a sectoral mismatch in Europe. And in the US, it's just that fewer people want to work. So it's very much easier in the US.
It's a great resignation. Another question, Patrick, maybe do not hesitate to push on some question. We'll try to answer as much as possible in the remaining 20 minutes of due time. Yes, exactly. But going to the market, we have some questions. So I was doing the transition on that. Where the short-term rates in euros should be, in your view, for the ECB to counter inflation to be effective?
I don't dare answering. No. Again, if you believe in my scenario, which is that either we'll have strong inflation coming from shortages and then less from wages, or strong inflation coming from wage growth and then less from commodities, then my calculation, if the ECB does nothing, inflation in 2024 would be about 3.5%, not 2%, which is not hyperinflation. Then, of course, a number, again, of my academic colleagues argue that it's fine. So why do we try to change that? It's fine having 3.5% inflation.
2 years ago, we were just pushing for the argument. Olivier Blanchard.
It was Blanchard's argument, which was completely different.
We need to be at 4%.
But it was completely different. Olivier's argument was that if you got higher inflation, you got higher nominal rates before recession, and then you can cut more. Now, the argument here is, do we have to fight to bring inflation back from 3.5 to 2? Is it worth fighting to get that? The answer, I think, is that I mean, 3.5% inflation would imply that we reindex everything in the economy, wages, pensions, taxes, whatever. If you reindex the economy, you lose whatever has been done since the 1980s, and you end up with very fragile and volatile economy, with everything being indexed on prices. So I don't think we like the idea of inflation being 3.5, but that's not the question. The question is, how much do you need to do to bring inflation from 3.5 to 2? And then the answer, if you look at the past, at past correlations, is that you need to have real interest rates above, slightly above growth rates. So if you look at the real 10-year today in Europe, you get it here. So that's the US. So you see nominal rates and expected inflation. So the real 10-year is about 0. So you need to bring the real 10-year to, let's say, 1.5. So you need to raise real interest rates by 150 BPs more than what we have today at the long end. That's long-term rates, which means probably that you need to have a 10-year in Europe that would be around 4.5%, and you know, let's say 4%, and you need the short-term rate to go to above 4% at a stage and then coming down later. So certainly not 2.5, it's more in the 4% range.
So just to give our scenario, central scenario is for the ECB to be at 1.5, so 200 BPs of tightening, and to get longer rates to be around 2.5, peaking and then going down. Yeah. My point is that what we do see in the US is a huge flattening of the curve because the central banks, we are probably behind the curve, are catching up. So we see that the inflation premium and the term premium is diminishing. So you have this inversion of the curve in the US, and we are close to record high difference between the 210 in Europe and the US. So what is striking for me is as well the fact that we do not see this bear flattening of the European curve. So if Patrick is right, we shall see, in fact, an inversion of the curve. So I'm not too sure that the 10-year yield will be going much higher, because then you will be pricing some recession, some deflation going forward, because the ECB is serious about fighting inflation. So then you shall see some inversion of the yield curve as well in Europe. So in both cases, I think we have a bit of a discrepancy between US and Europe. And we have some questions after on inflation.
I keep repeating myself, but again, if we get a much weaker economy in Europe because of shortages, we'll have a much more inflationary economy. And so the question for the ECB will be even worse. So you cannot get out of trouble by having a recession due to shortages and difficulty to import more energy. It would make the situation worse. So it's not helping having lower inflation. It's a recession which would make inflation worse. So if the market scenario is, okay, we have Russia, that's horrible, then the European economy will be very weak, and since it's very weak, inflation will disappear. This is completely wrong. If we have a continuing problem with importing commodities, we'll have higher inflation, energy prices will move up again, we have more inflation, and the problem for the ECB will be even more. So again, I repeat, the very, very big difference between the US and Europe is fiscal policy. Fiscal policy is making the job of the Federal Reserve much easier because it's going in the same direction as monetary policy. And this is exactly the opposite in Europe.
Yeah, assuming that budgetary policies are compensating fully the loss of pricing power.
At least the budget deficit this year will be about the same as last year in Europe. It's 5 points below in the US.
Yeah, but still probably some loss of consumption to be expected with loss of purchasing power. Question for still in inflation, we see huge difference between CPI and PCE in France, not the case in the US though. Which one is more accurate to measure the inflation? En passant, there is a lot of difference between CPI and PCE in US as well. It's a record high discrepancy. It's more than 2 points. So we see this kind of discrepancy in the US. Maybe just to leave the floor to Patrick on this one. But clearly we see a big difference in the weighting, for instance, of housing in the PCE and CPI in France, for instance. And we are mentioning France, and it's at 19% on one side and more than 30% on the other. So obviously when we see the impact of housing prices in the calculation, it's having a big weight. But which one is the more accurate? Probably like in the US, I will tend to say that PCE is better an indicator. But again, at the end of the day, it doesn't make a big difference. Patrick?
I can do an economist answer. First, the explanation of the difference is what we mentioned at first. that inflation in Europe is still more than half exogenous. It's not gone to the domestic developments of inflation. It's still linked only to commodity prices. And B, what should central banks look at? It very much depends on what you want to do. Then the question is, what is the cost of inflation in an economy? What is the reason why central banks want low inflation? It is because it's bad for welfare. So what's bad for welfare? Is it total inflation or is it core inflation? My feeling is that what's bad for welfare, what's distorting real incomes, what's causing problems with poverty and then purchasing power, it's total inflation. So I really don't see the point for core. I mean, I think and when you look at the debates now with central banks, so what central banks mention is total. I'm saying what's bad is that the people cannot buy their energy or their food. This is a problem with inflation. It's food and energy inflation. It's not core.
Even in the US, Jean-Paul lately justified its 75 BPs rate hike for the first time since 1984 and was mentioning, surprisingly, headline inflation CPI instead of core PC or core PC, which is the favored measure of the inflation for the Fed. We keep hearing that, but at the end of the day, the Fed is using headline CPI. Maybe a question that we can try to answer. At 4% euro 10-year rate, can Italy stay in the euro?
We did not discuss the anti-fragmentation mechanism, so we don't still have the details, but we know what it will be. It's reinvesting the amortization from PPP in the way the ECB wants to do, plus a scheme whereby the ECB will probably be able to buy Italy and sterilize. We still don't know exactly how they will sterilize. We know it won't be by selling Germany, because the Germans oppose that. It will probably be by sterilizing vis-à-vis the banks, what they do on the bond market with Italy. Now, this means that you've got, if this works and if this framework is credible, you will have exogenous interest rate spreads between the countries. They will be completely frozen by the ECB. The ECB will provide a free insurance against the volatility of spreads. This is a tremendous development. It's very good that you have the question because it means that the notion of peripherals disappear. Everyone becomes a core country. If everyone is a core country, their crises disappear. You've got a Eurobond. You got a single European debt, which is the debts of all the countries put together with exogenous spreads, which are insured and stabilized by the ECB. So in that case, you get rid of crisis. It's completely clear. This is a precondition for the ECB to hike. This is why the ECB wants to do that rapidly, because they cannot really hike as long as this problem has not been solved. And when it's done, you've got a Eurobond. You've got a single European debt, just with spreads, but the spreads are exogenous. So the degree of risk in the different countries becomes the same. But you end up with a tremendous moral hazard, because if you are a perverse Italian government, the way you've got that, then you run a 15% of GDP budget deficit forever. So this is also making the need for a new stability pact very important. You've got to control this moral hazard. So you need fiscal rules if you got this freezing of interest rate spreads.
So what is discussed at the moment is to go by the rule of the European Commission. So that's a kind of a new stability pact. So it's like an OMT 2.0 without the stigmatization. But that's very important what Patrick just mentioned. If you decide not to sell Germany to buy Italy, then you do not respect the key allocation capital in your buyings within the ECB. So it's totally at the end of the ECB to decide to buy Italy, because Italy is doing a good job of reforming its economy and doesn't deserve any widening of spread. So that's very, very strong instrument. Having said that, in our view, why the ECB is going to decide that, we are going to see that tomorrow. Maybe some details, but it's going to be announced 21st of July. It's probably a way for the ECB to accelerate the normalization of its interest rate. So it's not it's a bit of a counterbalancing effect. since they are going to hike rates, they are going to implement this anti-fragmentation. And maybe another argument as well is that if you are having a 10-year rates in Europe at 4%, it's because you have inflation, and if you have inflation as well, you have an effect on the debt sustainability, as it's quite favorable for reducing your debt to GDP, obviously as well. So again, Italy has a primary surplus, Italy has a current account surplus, blah blah blah. So it's more maybe not the end game for Italy at 4% as your question. Maybe a question that something that we didn't discuss around China is China could be increasing its the price of manufacturing products. That's another good question. China is not anymore exporting deflation, but inflation in a way. What we have seen of late is you have PPI, so production prices in China up by 6%, but export prices from China to Europe up by 13%. So we clearly see some kind of pricing power from China, and China is taking an opportunity from that to increase its export prices to the world. So China is not anymore exporting deflation. So yes, it's clearly something. Having said that, that's the only engine of growth in China remaining, that's exports. So it's very difficult to imagine, and look at what they're doing with the renminbi. It's very difficult as well to imagine that China is going to put in danger its exports. So do not expect export prices of China to keep rising without big effect on the GDP growth. Xi Jinping, he needs to be. It seems to be quite close to impossible to be at 5% now, but clearly he needs to see some good growth numbers. So for that, he needs a good export number, and for that, he needs lower prices.
So perhaps to finish, we need to spend the 3 remaining minutes on the markets. So just let's do like that. Suppose you don't believe whatever we said. So you stay with a very large uncertainty. So uncertainty on the cycle, on the cyclical developments, uncertainty on inflation, uncertainty on the reaction of central banks. So you've got a huge uncertainty, and this is very much true, a huge uncertainty both on growth, on inflation, on interest rates, nominal and real interest rates. So what should you do in an asset allocation if you've got this triple uncertainty? A, you should avoid whatever is cyclical. Cyclical is, for instance, high yield. You see the widening of spreads. It's LBO debt. It's CLOs. It's whatever is linked to the cycle. So avoid whatever is linked to the cycle. This is true for dividends as well. So listed equities are also cyclical assets. B, you should avoid whatever has a very large and a robust elasticity vis-a-vis real interest rates. And then you know that this is the case for P ratios, so for listed equities. This is very much more smoothly the case for private equity, and this is the case for residential housing. And C, what you should favor in the portfolio is investments in assets which are not cyclical, so for which there is a constant strong demand, and B, which protect against inflation. And when you look at that, you don't have a lot. A mistake which is very often done is to believe that residential property protects against inflation. Look at rents and CPI in Europe. You see that there is absolutely no correlation. So in reality, residential property is a very bad hedge against inflation. So you're left, again, if you prefer non-cyclical investments, non-cyclical assets, and assets which deliver inflation-linked incomes, you're left with commercial property, with rents which are very, very closely linked to inflation, and you're left with a part of infrastructures, especially those who are associated with energy transition, which are non-cyclical, strong continuing demand, and no big links to real interest rates. But the rest, of course, you've got normally to avoid, again, including bonds, including loans, including structured loans, including LBO debt, including residential investment, and including listed equities. All that is either very cyclical or very much linked to real interest rate increases. So in reality, you are left with few assets you can confidently invest in, not forever, but let's say in the next 6 months.
No, totally agree on the asset allocation side. And once again, usual an average recession in the US, you end up with earnings down by 20% in the S&P. The EPS forward is not even down 1%, so it's even more the case in Europe. So if you look at stock market, you are still not very, very cheap. We are back to average, but not that cheap. It's even worse on credit. The widening is mostly due to rising rates, nominal rates. So yes, like Patrick said, it's very difficult to imagine even the real estate. So probably we have to play some thematic on the green transition, on to play that kind of things. But yes, we have to be cautious because it's probably not the end of the game. Maybe to take on some question around the macro and date and rates to be between two worlds, between macro and markets. Higher rates means a more costly debt. How to repay it? More taxes is the question, Patrick. Just on my side to say that obviously higher rates is a big impact on public finances, and we have made the calculation few years ago. In fact, for the French Commission, and what we end up as a calculation is 1% more of interest rate translates into something like close to 30 billion more of interest rate payments 10 years after that. So 30 billion for 1% increase of our rate. So we are at 2.5 now. So obviously this is very costly. It's probably close to 40 billion more 10 years from now with this kind of rates. The Ministry of Finance in France is communicating figures that this year, 2022, is going to cost 17 billion more because of index linked, because of the cost of debt. But look at the big picture. Today we have a 113% of debt to GDP in France, and we are paying 3 times less in interest rate to cost than it was the case when we had a debt of 60% of GDP. So the average level of rate is still much lower than the average stock of debt, and we have duration of 7-8 years, even more than that now. So it takes time to impact the cost of debt of interest in time. So yes, this is a big problem. How we end up, probably a bit of more inflation. If we can have a bit more of growth, taxes. I don't know, Patrick, your view.
No, you can do a very simple calculation. If you want to bring, I take France, but you could take Italy, Spain, whatever. If you want to bring the budget deficit back to 3% of GDP in 5 years, in 2027, at the end of this current mandate, then you've got to bring the deficit from 5% this year, I take the official figure, to 3%. And at the same time, you've got to do that, offsetting the rise in interest payments. So when you calculate everything, what you need to do is to bring the primary budget surplus, the primary budget deficit, X the interest payments on public debt, down by 100 billion euros in France from between now, between this year and 2027. So it's a 4 points of GDP, 4 point of GDP reduction is the primary deficit in 4 years. So it's 1 point a year. Now, the Americans just did 5 this year. So 5 points a year is feasible. But at the same time, how do you do that? You want to spend more on everything, basically, on education, on healthcare, on defense, on energy transition. And you want to keep cutting a number of taxes, especially production taxes, which is a good idea. So how do you bring the primary budget deficit by 100 billion euros down in 4 years? There is a very simple solution, which is to increase taxes by 100 billion euros. That's not very popular.
Good luck with that.
And then you got the possibility to have more growth, but honestly, that's not very easy to believe. Productivity now is in negative territories in France and in Europe, which is very bad news. Post-COVID productivity has accelerated in the US. It has gone to negative territories in Europe. Much of that is due to shorter hours worked, which is taking per head productivity down. You've got aging, so it's very hard to believe in a rally in potential growth in the next 5 years. So I'm very worried, honestly, and I don't have a clue. I don't know what will be done. It's a question the governments don't ask today. It's too early, probably, but in the course of these 5 years, I think we will have something has to break. It's either the idea that there would be no tax increases, or what's been decided in terms of public spending, or it's a stability pact, which means that countries would keep a budget deficit much higher than what's normally expected in Europe. But something has to break in terms of the trajectory of fiscal policy.
Something has to give, and we have to give back the mic because time is ticking up. Thank you for all these questions. So maybe to summarize, again, it's a new regime, we can say, in a kind of a conclusion to this debate. It's difficult to have a clear view on the dynamics, how long is going to take, where does it take us. But clearly, for us, it's a new regime, and to give you our central scenario, we still expect inflation to be above 7% on average this year in Eurozone, but to be back to below 4% next year, even with this energy prices up, 4% wage growth, this kind of thing in Europe, we end up with a much lower inflation, but still well above the inflation target next year, 4% next year on core CPI, very close to 4% next year again. So this is a new paradigm. This is a new regime for inflation in our view. Big question mark is 1, energy, 2, wage negotiation and dynamics. Well, we'll see, and I propose that we will discuss that later on to see where we stand. Thank you very much for being with us, and do not hesitate to reach out to the team for additional questions. Thank you very much for being there.